When you're applying for insurance, there's a number of ways that you can actually do this. One of the bigger decisions that you'll make is whether you're going to have a crack at doing this yourself or whether you're going to engage the services of a professional like me. In this video, I'm going to address this a bit further and share with you some pros and cons of each method. Hi guys, welcome back to the channel. My name's Craig and I'm a self-confessed insurance nerd. And on this channel, I try and humanize the world of insurance to provide peace of mind for you and your family. I've been working in the insurance space for over 15 years. Now, I'm under no disillusion that it's very unlikely that you'll choose to spend the spare time that you have taking the time to sit down and talk at length about insurances. In saying this, if you are watching this video, then I'm sure you can appreciate the peace of mind that a proper, well-constructed defense strategy can provide for you and your family. So today I'm going to walk through 3 points for you to consider when you're deciding whether to go this alone or engage the help of a professional. Now, the first concern that I normally see is the lack of trust that there is in financial advisors. And I can appreciate that this is an absolute genuine fear. In recent times, the Royal Commission has certainly not painted the industry in a great light. So what should you look for if you are looking to find an advisor? Firstly, I'd be speaking to my friends and asking for any referrals from people who have done a similar thing that you're trying to achieve. Number 2 is my favorite, it's the online research, and you can start with doing a Google search, which will have a look at Google reviews. Just being careful to spot the fake Google reviews. So for me, a good Google review will be in-depth, outline the problem, have a photo, and for me, I actually like to see people that are engaged with the reviews. So you'll notice if you look at the True Pride ones, there's a response to every review that's been left there. I believe that this just adds a level of credibility to those reviews so that you know that they're genuine. Secondly, there's a site called Advisor Ratings, which you can search for the advisors and they'll have, again, personal ratings if the advisor hasn't used Google reviews. The third thing you could do is check out their YouTube channel. Now, the next thing to do once you've done a bit of research online and you've narrowed down maybe a couple of advisors is book in a conversation. Most advisors will offer a free opportunity to have a conversation with you so that they and you can find out a bit more about what you're trying to do and if and how they can help. My suggestion here was, what does your gut tell you? Do you feel comfortable on the call? Is it easy to talk to? Does the conversation flow? Is it a yes or a no? Derek Sivers has an awesome quote that I like a lot, and it's either a hell yes or it's a no. Now, during this conversation, you might want to know a couple of questions, and here are a few that you could use. Number 1, can you tell me about your typical client? And what you're trying to work out here is, are the people that this advisor helps similar to you and similar to the things that you're looking to achieve? Secondly, can you walk me through how this will work? And the reason I suggest this question is it'll give you an idea as whether or not there's a process that's being followed. For me, the likelihood of success comes down to the repeatability of the process. The next thing you could ask is, how do you charge? Now, there's no right or wrong answer to this one. I just believe that it should be very clear, it should be transparent, and you should be well aware of how this actually works. The final thing when it comes to trusting advisors is the fear of the cost and the fear of the word commissions. Now, the word commission itself has been a bit of a dirty word in the industry. From my experience, it's not the commission itself that's the problem, it's the lack of transparency. Your advisor should be able to explain the way that they charge, how this impacts your premiums, and allow you to make a decision that's in the best interest for you. Finally, if there's any ongoing payments, the advisor should be able to explain to you what you'll receive for any ongoing payments that they receive by you placing the business with them. Again, transparency is the key here. The next major thing that I come across when you're deciding between an advisor and going it alone is whether or not you'll go back to your existing super fund and just apply for insurance with them out of simplicity. If you are after simplicity, then I can completely understand this logic. In my experience, having done a lot of research into these existing funds, like the industry funds that are very common, there are a few things that you miss out by going down this path. Firstly, you'll often get an inferior product that is more expensive. Now, if you think about that for a second, typically if something's cheaper, you generally think that it's going to be of less quality. During the second step of my DFAN method, which you can check out over here, this is the step of formulating the advice. And in this step, we research the existing funds and then compare this to the products and quotes that are available in the rest of the market. In 9 out of 10 cases, when compared to these industry funds, not only are we able to find a cheaper product, but we're able to find that same cheaper product that's actually better quality. The good news, that even if you do go down this path, you don't have to move your superannuation fund, which I've explained in a separate video as well. The next thing to consider if you're just going to go back to your existing super fund is the limited underwriting that are provided with a lot of these funds. Now, underwriting is the process of the insurance company assessing the risk that you present when you apply for insurance with them. Should you wish to apply for insurance with these industry funds, the underwriting that's requested is often very limited, meaning they'll ask you very few questions about your health to submit that insurance application. On the surface, this may actually sound like a really good thing, but that is until you need to claim on these policies. The risk at claim time is if the insurance companies decide that they wouldn't have offered you the cover in the first place, they may not pay the claim that you thought that you were entitled to. Now, I'm not trying to scare you with this comment, as there is a chance that you may not have been covered for this no matter where you went in the market. The big difference, in my opinion, is that at least you would have known that up front and you could have made alternate plans to protect yourself, knowing full well what was covered and what wasn't in the insurances that you're paying for. The last point to consider if you're thinking about going back to your existing super fund is not having any direct point of contact. Now, this may not be a deal breaker for you, but you would be responsible for any alterations to the policy, any adjustments, keeping abreast of pricing changes, which is really common at the moment and something we're seeing a lot of. Now, I would hate to add up all the time that I've spent listening to Michael Bublé on hold music, but it certainly would be a lot over the years. The reason for this is that we take that responsibility of the administration of these policies so that you don't have that. And that's certainly something you would miss out on by not having that direct point of contact. The most important thing to consider about not having that point of contact is should you need to claim. Now, a good advisor who helps you with your insurances should facilitate the claim for you, making the process as easy as possible at the time that you need it most. Should you go this alone and go direct to the insurance company, this is something that you'll have to handle all on your own. The last thing to consider when you're looking at an advisor versus doing it alone is the opportunity cost. Now, I was talking to a planner mate of mine last week, and he said that he has a saying that nobody needs a financial planner. And I completely agree, in the same way that nobody needs a personal trainer. The reason that we may choose to do this is often to shorten that learning curve and allow us to focus on the things that we actually like and the things that we're good at. So here are a few things to consider if you are looking to do the insurances on your own. Firstly, how long is it going to take you to get up to speed to the point where you can make a decision on this? As I mentioned, I've been in this insurance space for over 15 years. Now, I'm not saying it's going to take you 15 years to understand, because you'll probably learn a lot quicker than me. But I do live and breathe this stuff, believe it or not, and probably spend more time than most in this space. Not that you need to spend 15 years doing this, but I'd ask you the question, how much time do you have to invest in upskilling yourself with everything that you need to know in the insurance world? Secondly, what else could you be doing with your time? Now, traditionally, going through an advisor used to take a lot of time out of your day. You had to drive to someone's office, potentially have someone look after the kids, take time out of work, and it was a pretty big time commitment. These days, most advisors offer digital appointments online at a time that suits, rather than having to mess around with the meetings in person that used to take up a big chunk of time. So with the reduction of time that it takes to see an advisor, what are the other things that you actually enjoy doing that you could be doing as opposed to doing the research into the insurances? The last point to consider here is, are you confident with the data points? And what I mean by this is, if you are researching this online, are you confident that the person or the people that you are following are correct? And do you have a reference point for checking this? One of the reasons that I started making these videos is due to the lack of information that I could find online. There is some really good references, and I talk about Scott Pape and the Barefoot Investor a lot, and I do like a lot of the sentiments that he has about insurance, and he has helped people get protection a lot more than other people in the market. Now, we do have some differing opinions about where to place the insurance, but the sentiment of only protecting the things that will kill you financially, I completely agree with. So if you are thinking about going this alone, I hope this video has provided you with a bit of food for thought on what to consider if you are going down this path. If you're interested in understanding the steps that I think are required to get your insurance sorted properly, check out this video as I'll walk you through my defend method, including all of the steps involved. I'll see you there.